Good morning, everyone. My name is Louise Kelly, and I am an audit partner in Grant Thornton in Belfast. I'm hoping the technology is all standing up and we can all hear you, or you can all hear me. I might just ask our panelists to give me the thumbs up if everything you can hear. That's good. That's a good start. Well, I would like to welcome you all to our webinar and thank you for joining us this morning virtually. In this webinar this morning, we have gathered some of our experts together to cut through the noise and outline some practical tips that your business can take to navigate these unprecedented times. My job this morning is to introduce the speakers and keep us all on schedule so that we finish within the hour. We would also like to welcome questions. Please submit questions at any time during the presentations to the Q&A tab, which is at the bottom of your screen. And then I will compile some questions and ask them at the end of all the presentations. So let me start this morning by introducing Andrew Webb, our Chief Economist, who's going to discuss the current economic challenges. Now, Andrew, we just heard this morning that Ryanair are potentially going to lay off 3,000 people. And no doubt other airlines will follow. This isn't good news for the economy in general. Can you tell us about how the economy is faring and the prospects for when we emerge from lockdown?
Thank you, Louise, and good morning, everybody. That's a tough start to the day in terms of how the economy is performing, and I suppose what it does do is really put into stark context just how much of what I had proposed to start telling you is such a historical curiosity now, given that the pace of change is so frenetic. We were in a very strong labour market previously, and the economic performance of Northern Ireland had really enjoyed a significant period of growth, labour market strength in particular. I suppose while this is very much a historical picture now in a historical context, and we see day and daily now news stories of economic change and economic hardship, I think it's important to start any sort of unpicking where we are and where we're going with the fundamentals that were in place on the economy as we headed into this pandemic. And I suppose it's important also to say that the economy, while it had been strong and had been growing, there were some fundamental challenges on the horizon, not least of which was Brexit, but also the age-old challenges for the Northern Ireland economy that haven't gone away during this. So, we do face into challenges around productivity, challenges around high areas of deprivation. But as I say, for a bit of context, we came into this in a reasonable position of strength. But you're right, day and daily we're hearing stories like the one this morning about Ryanair of ever-increasing hardship. So it's important to set that context, but let's now take a look at where we are in the current situation, and particularly in how the labour market has reacted to the shutdown in the economy. And while there are lots of news stories circling on a daily basis, it's difficult to get real-time information on where the economy is from the official statistics. So we start to lean on more of the real-time indicators, and one of which has been particularly useful in showing where we're heading here is job postings on Indeed UK's website. And of course, we look at this on an all-island basis too, and the trends are similar across UK and Ireland. And what it shows is that Indeed, which is probably arguably the largest online recruiter in the UK, has shown a significant decline in job postings. So understandably, as the economy went into lockdown, a very rapid and immediate decline in labour market performance. We're also seeing that on the claimant side. So universal credit claims surged. There were 26,000 or 20,000 new claims in a fortnight recently, which was 6 times more than usual. So a very immediate labour market contraction, and we will see that flow through the economy in the coming weeks as official statistics start to emerge. And if we look at just how that has impacted sectorally, that impact's being felt right across the board. I don't think there's only the health sector has managed to escape a decline in, this is a graph on output losses. So we've flipped from labour market into how the economy is performing here in terms of output. And at a whole economy level, the Office for Budget Responsibilities suggesting that the Q2 impact on the whole economy will be a 35% decline, and that impacts differently across various sectors. Education, which is primarily the impact of university closures there, and a decline was already being felt before we went into lockdown, certainly across the UK. At university level and further education level, as international students isolated themselves and were subject to their own travel restrictions and suggestions that their own countries were going into lockdown, so they stayed away. So education's felt a particular brunt there, and as we all know from our own local experiences, the tourism and hospitality sector is facing into a particularly difficult time at the minute. But as I say, no one sector is, other than health and social care activities, is expected to grow within this period. So the economy has gone into that deep freeze, and as I say, overall a contraction expected of about 35%. How this plays out across Northern Ireland has been also worked through the numbers from the Office for Budget Responsibility. Just on the next slide, we can see that there's a varying degree of impact here across Northern Ireland. Mid-Ulster projected to suffer the biggest decline. Mid-Ulster being, of course, Northern Ireland's manufacturing heartland. And we look at on the other side of that, and we think Derry, City and Strabane and Belfast not as impacted relatively, but Belfast certainly a much larger economy than most other local authorities. So that a 30% decline in a Belfast context is a deeply significant impact. Derry, City and Strabane has been buffeted somewhat by the fact that and Belfast to a certain extent too, by the large presence of public administration jobs. And Derry, City and Strabane has been slightly buffeted too by higher levels of economic activity, actually. So that's been somewhat of a buffer in this circumstance, although a long-term challenge for that economy. I suppose key to how these estimates, and they are estimates at the minute of how the economy will be impacted in Q2, and key to how these estimates translate into actuals will be confidence. Confidence is at the heart of pretty much every business decision and every consumer decision, and confidence has been absolutely shattered by the pandemic and the subsequent lockdown, and that we're seeing that in the likes of the Purchasing Managers Index from Ulster Bank, which is showing already significant declines in the whole economy. We're talking record lows here in terms of these sorts of indicators. Overall, we're talking a rating of 39 for the overall economy, where 50 or above represents expansion in the economy, and anything below 50 represents a contraction. So these are significant declines already coming through in terms of output. So what might the economy look like after this, I suppose, is what we're all now turning our attention to. And as other countries and other regions start to move out of lockdown, we are getting increasing messages around how we move out of lockdown and what the economy looks like and where we go to. And I think there's been a fair amount of media coverage around what the economy does here. I think the ambition and the various schemes that the government introduced with regards to job retention schemes and the various supports that were put in place were really an aim to get a V-shaped decline and a very quick bounce back in the economy. That looks increasingly unlikely from the analysis that we see and hear, and the analysis from the likes of Ulster University, who are starting to think around what this looks like going forward, and they're talking about a decline this year of close to 10%. Danske Bank's forecasts out this week talking about 7.5, with a bit of a bounce back next year of about 5%, I think they were predicting. At the minute, this is very much a guessing game, and I really don't envy anyone who's sitting with a forecast model at the minute, because it could go pretty much one of three ways. It could be that V-shape, sharp decline and sharp expansion. I don't think that's where we're headed at all. I think we'd be doing quite well if we get a U-shape, which would be a sharp contraction, a period of a longer period of moving across at a trough and then an incline back again. And it just, as I suppose, as the longer the lockdown goes on, that becomes ever more likely. The big fear is that we end up with an L shape in economic performance, which is a very sharp decline and a movement along at the bottom of that for a protracted period of time. And there is some evidence building to suggest that there will be, as we've gone into limp mode, and that as we move through this, there are companies that, while the various initiatives that have been introduced have been very welcome and have been rapid, and that's to the credit of the government and the pace of their reaction. But there is evidence building that there have been increases in company dissolutions, and work from the Enterprise Research Centre has suggested that the Q1 number of companies dissolved in 2020 is about 6 times higher than the same period in 2019. And in tandem with that, the number of new business starts in Q1 is significantly down on the same period last year. So there does seem to be some evidence building of some lasting damage here as we move through this. So that risk that the economy doesn't power up as quickly as it powered down is very real. And as I said, in terms of confidence, that will really determine how we start to come out of this and how we react out of this. So the chart there suggests how confident consumers feel based on a YouGov poll, which was how would you feel about going to these various places when we're allowed back to them, and there's varying degrees of confidence around how people will feel about going to, for the likes of garden centres, people will feel more comfortable. There's an open air element to that, and they're usually in a larger footprint. But the likes of gyms and pubs and bars, which are usually more tightly packed, or people feel less confident about going, and restaurants again. So lots of challenges to be unpicked as we move forward, and lots of really big questions that we need to think through. And this is maybe where the opportunity might start to appear in this. So as I think it might, economic behavior alter fundamentally? So we start thinking, we've had supply chain issues with various countries locking down and difficulties there in sourcing goods and products. So do we move to a more localized supply chain, and does that offer an opportunity? And in the consumer world, do changing consumer patterns start to see us move from the sharing economy, which has really benefited in the last 4 or 5 years, to a more isolation economy? And does that offer opportunities, and does that offer economic potential for some growth areas? So to end on a slightly more upbeat note than the various slides before that might have suggested, the economy will come back. It always does. I think when and how is the uncertainty in this, but given the pace that the government reacted to support businesses in lockdown, I think the message that's certainly coming through from various forums that I've been involved in is that the economy will need a push to get going, and that the government can't just stop with its various supports, that it has to keep moving in that direction with ever more support to key sectors, and that there will be opportunities that come out of this for certain areas. So on that note, I'll finish and pass on to the next speaker.
Thank you, Andrew. Nothing like getting the bad news out of the way first. Hopefully it'll be a bit more positive now with the rest of our speakers. So I'd now like to introduce you to Neil Shanks, who is one of our corporate finance directors. And Neil's going to cover managing working capital. Now, as an audit partner, I am only too aware of client challenges over the last 5 weeks regarding cash flow. So Neil, what should businesses be doing to manage through this and to come out the other side?
Thanks, Louise. Yeah, I think there's a number of things businesses can be doing. Obviously looking at cash, there needs to be closer control of cash flow. As far out visibility as you can possibly see in your cash flow and the circumstances. I need to be a wee bit more active about management of working capital. So moving away from processes where it's largely driven by amounts and days, and thinking about working capital a bit more strategically, and looking at each element of your working capital. And as I say, I think thinking beyond the normal process. And it's really about identifying the issues or the possible issues as early as possible, and taking action on those issues as early as possible. You know, and even looking for opportunities. You know, you may look at your cash flow and see potential opportunities. I mean, every business at the minute is looking at its current position, how it's going to move through various phases, and when is normality going to return, or is your business in a sector where you're going to have a new normality, as people are talking about. And at the outset here, I guess people were looking at, you know, maximize cash in, minimize cash out, and that's fine to an extent. But I guess the risk is that you do that to the extent where you've held back on your creditors so much, you've run down your debtors, you've run down your stock, and you don't have that ability to get your working capital cycle up and running again when things start to move and you start to trade. So, you know, that's something to be very mindful of, and also building into all of your cash flow forecasts. When will the government supports turn off? What is the impact at those trigger points, and how do you manage that? So I guess just moving to the slides. I mean, there's, you know your current position. I mean, it's stating the obvious, but, you know, what cash have you available? You know, looking at your working capital facilities. And I think there you might want to go to the, sorry, we just moved back a slide. You know, there you might want to go to the bank and just confirm that there's no issues. Confirm that you're not going to be hit with an expiry of your working capital facilities. Confirm that there's no covenant compliance issues, and just make sure that they're in place. As I said at the outset, I think it's about thinking about a bit more strategically about your elements of working capital, you know, rather than process driven, and being able to have visibility over how your current trade moves through the phases and how you come out the other side of this. You know, your business recovery plan should be largely aligned with a working capital plan and a cash flow management plan. Again, I'm sure everybody's maximizing the use of the various government support schemes, and that's great. And as Andrew said, the government moved pretty quickly to put those in place. I guess the danger there is having a reliance on those schemes, and when they're turned off. So when payroll hits, you know, have you managed your cash flow to the extent where you can pick that up again? When tax is due, when rates are due, you know, it's planning ahead for those and making sure that you can absorb that. And then in terms of, you know, if businesses take on more debt, you know, that coronavirus business interruption loan scheme is very helpful. You know, use it if needed. You know, apply for it if you feel you might need a buffer. But I guess one thing that the businesses should be looking at is when you come out the other side, taking your existing debt and taking any new debt that you've taken on, you know, do you need to start thinking early about restructuring your debt? And is that relatively simplistic? Is that about, you know, looking at revised repayment plans, looking at revised pricing structures? Or is that something a bit more complicated? I mean, largely a lot of debt restructures are driven by tax efficiency. So, you know, that's something to think about. You know, do you use your pension scheme and potentially do a sale and lease back of your property? Do you look at bringing in equity or debt for equity swaps? So, you know, all of that sort of stuff, you know, we should be thinking about earlier and engaging with the bank if we think a debt restructure is needed. So yeah, so I guess in the rest of the slides, I just want to talk a wee bit more about working capital, some practical tips that hopefully might be useful to people. And I'm just going to start in the next slide talking a wee bit about cash flow forecasting. So yeah, so what is a cash flow forecast? Well, it's relatively simple, and the simpler you keep it, you know, often the better it is to use. So it's, you know, taking a set of assumptions, what cash is coming in, what cash is going out, what is the net impact, and where does that leave you in terms of your cash position, including any working capital facilities that you have. So a few key points around this. I mean, the period you look at, you know, normally it's maybe 3 to 6 months, but, you know, we're in exceptional times and businesses face very different challenges. So, you know, to take an example, you may have a car repair business. Their assumptions might be cars have been sitting idle. People don't want to use public transport when things get up and running again. Cars will break down. I'm going to be busy. And you might look at a 6 to 9 week cash flow to say, well, that's when I think I'll be up and running again. Obviously, you know, at the other end of the spectrum, you have bars and restaurants who could be looking at 9, 12 months, you know, for their cash flow. And the other thing to build into it then is a bit of flexibility. So again, you know, taking on that example of bars and restaurants, you know, maybe your assumption is that by Christmas, you're hoping to have revenue based on 70% occupancy. You know, what if that's 50% occupancy? You need to be able to see what what that looks like. I would include all the government supports in your cash flows. As I say, they're great. When is that money coming in? But more equally importantly, when is that money being turned off? And you have to absorb that within your own business. Include your automatic payments, your direct debits and standing orders. I think it'd be a worthwhile exercise just to go into your online banking. You should be able to see all of your direct debits and standing orders, and just make sure that you're actively managing those. I mean, often it's the annual direct debit that everybody forgets about that just happens to come out and could cause you an issue. So it's active management, and it's active management through the current period, but making sure that you can come out the other side of it. And I guess just the final point in this slide is to assign a central owner of your cash flow forecast. Somebody who will take ownership of the document itself, usually an Excel spreadsheet, and communicate that. And I would suggest that goes out to everybody weekly. So just moving on to looking at the various elements of working capital. So firstly, I guess debtor management. I mean, cash on delivery where possible. Appreciate that's difficult in certain sectors and difficult in these times, but if possible, get cash on delivery. Be proactive about debtor collection. And again, as I said at the start, that's about looking beyond days and amounts. What is the relationship with this customer? What shape will their business be in? Is this somebody we should be chasing? Can we get success in this? And you may want to apply a system, a sort of traffic light system, green, amber for a watch list, red for an action plan. Or you might want to have a rolling top 10 that you're pushing. And that doesn't necessarily need to be the largest debtors you have. That can be the ones which are, you assign the most importance to, and where you want to focus your efforts. And you want to focus your efforts where you're likely to be most successful, or you see the most risk. So if you have a debtor that is going to pay, they're going to pay on 30 days, they're not going to pay earlier, not going to pay later, and it's not a risk. That may be a large debtor, but it's not where you should focus your active management and your attentions. Manage your future credit risk for existing and new customers. So look at their terms, look at their limits, adjust those if you feel you're exposed. And then it's it's carrot and stick. Do you consider incentives for certain customers who your customers, the relationship you have? Where will you be successful if you offer a discount, and is it worth offering? And on the other side of that, equally, your customers that might need to be pushed. And if you have the right to charge interest on late payments, that's something you should consider. I think it's worth also looking at your insurance cover. So do you have debtor insurance? If not, can you get it? And in a worst case scenario, you should be looking at your contracts. If you feel you're really exposed, you should be looking at your rights to suspend or rights to terminate a contract. And then underlying all of this, I guess, we all have our businesses to come out to the other side. So, manage those key relationships and manage reputation. I think consistency here will be key and a challenge to manage. And you'll not be able to be consistent right across your customer base. You're going to have to take different approaches, but at least if you can treat different groups equally, that's a certain level of consistency. So looking at the other two aspects of working capital, around your creditors, minimize payments out, defer any non-necessary spend. You might want to think about sign-off limits and anything going out might need to be justified and signed off at a certain level. Consider the cash impact of all of your cost reduction plans. So, what does it do for your business? But also consider, is that impacting your cash? If it is, then it's worth pushing ahead with. If it's not, then you may want to reconsider, is it worth doing? As with debtors, negotiate with your creditors, negotiate with your suppliers. There's an interdependence there. They need you going forward. So there should be some willingness to work with you. And similarly, rent, that's a key cost, and it's something you should certainly be negotiating. And again, as with debtors, consider, if in a worst case scenario, do you need to suspend a contract? Do you need to terminate a contract? And again, underlying all that, manage your key supplier relationships, manage your reputation. So finally, stock. I guess here's a couple of key points. You need to assess your critical needs going forward. And that's again tying back to the original point where you need to be able to get your working capital cycle up and running again and trade through the other side of the current period. realize stock where possible, and you can get cash injections into the business, or indeed unutilized assets. I mean, there may be a machine sitting at the back of the store that you could sell on, you don't use anymore. Now is the time to do that if you can get reasonable value. And final point is to manage your supply chain and the risk of obsolete stock. So what's coming in, rotation is more important than ever. What's coming in, what are you holding, what's going out? I mean, a lot of industries probably haven't had to worry about that too much. You take the bar industry, probably didn't have to worry about it too much, but they do now, and I'm sure they're all thinking about their stock and potential deals and promotions to move that on as and when things start to trade. So that's a quick run through. Hopefully there's something practical in that for you.
Thank you, Neil. I think there's some really good, clear points on managing working capital. Just as a reminder, we've been getting some questions through on the Q&A. So the Q&A box is at the bottom of your screen. So if there's any questions you'd like us to answer at the end, please send them through and I will ask them of the panelists at the end of the last presentation. So our third panelist today is Charlie Curlin, another one of our corporate finance directors, and he's going to speak about dealing with funders. Now, Charlie, I know you're going to cover off in a practical way how clients interact with their funders, and particularly around the government-supported loan scheme. But circa 5 weeks in, what are some of the key takeaways you have seen in conversations with funders and clients?
Okay, thanks, Louise, and good morning to everyone. And certainly, it has been a very, very unprecedented 5 weeks, and certainly, I think one of the key messages, there has been lots of learning. We've learned, funders have learned, etc., and clients are learning. So, hopefully this morning, this is about a practical session around how to navigate through some of that choppy waters. I suppose big picture stuff. What are we learning? Certainly from there's a lot of talk around obviously the government supported loan schemes. Banks are at pains to say, and we've been saying to clients as well, there's a lot more in the armory for the funders. Particularly around what Neil said about the capit moratoria, covenant waivers, and certainly also looking at the maybe temporary overdraft facilities, for instance, particularly for people who have invoice discounting lines where obviously the sales may well be going off a cliff. There's been, I suppose, criticism of the banks in relation to the start of the process, and I think it certainly at the start it was very much a stop-start process as people understood sort of the criteria, and obviously this was very much foisted on the banks in very, very short notice. And certainly, anecdotally, that has very much improved, and obviously there is the move now through to approvals and then hopefully into drawdown. I think the other one is banks are very much, and funders are sympathetic and listening to clients, as well as the financial and economic issues there. There is a lot of personal health type issues, etc. as well. So I think people are very aware that a lot of things are hitting people, and certainly in relation to levels of information, detailed information, I think again there has been a response there from funders. Big issue, certainly probably a number of weeks ago, was that issue of clients said, should I actually go to a new funder now? And certainly from the get-go we were saying not a good idea. The government had obviously confirmed that companies could go to whatever approved funder was there. Certainly, but just practicalities around knowledge of the client, the management team, and even take on and security issues meant that was going to be always very, very difficult. BBB have obviously done good work in relation to approving more funders, and obviously there's welcome news this week of AIB joining the panel, which is good. I suppose the last takeaway probably is that there is a level of people having a conversation with the bank in relation to whether should they apply for the CBILS or not, and certainly within the banks in the application, some triaging there in relation to necessity, and also certainly for companies that are looking below that 250K of ask. So maybe good if we move on to the slides. I mean, what I want to do is try and look, I suppose, practically around the government-backed loan schemes and the practicalities. But I suppose firstly, maybe looking from the funder's perspective, and to split this into two slides. And I think at the top of the slide, I've maybe indicated what I would think is maybe some of the normal ask from the funders. In the second list are probably areas where there is that bit of more detail for the government-backed schemes. Not going to go through this in detail, but I suppose some key messages of that importance of good and regular communication with the funder. I think that is vital. Making sure that there is no surprises when they receive the application. There's very much that focus on cash and the ability to repay. So that is where the big focus is on. And certainly in relation to the projections, there is the typical one of when, this is so fluid, when do I actually can pull a set of projections together? This is all about trying to put the best foot forward, and at some point in time you then have to make a cut in relation to what is the starting point for those. So on to the next slide, if we look at some of the specifics then around the CBILS and CBILS loan application. I mean, the first one is these government funds are in respect of COVID-19. So the very easy one that nobody seems to have a problem with is the how has COVID-19 actually impacted your business? So again, that is something that needs to be clearly identified. The second issue, and one that we have probably had the most conversations with clients and interaction with the bank is in the whole area of viability. And I suppose that to simplify it effectively, what the bank is asking is, would I have lent to this organization this loan pre-COVID-19? So the key reference information has been the last set of annual accounts for the company, and to a certain extent then beyond that where there is updated management accounts. And a case in point where a client we were dealing with last week, where they had an upturn in their business in the period up to the end of December 19. They had a March year end, but we then did a rolling 12-month figures to the end of December as being the reference point. The third element there is the point in relation to forecasts, and clearly from the client and the funder's point of view is to identifying what is the quantum of the ask and when is that likely to happen. And the projections then clearly need to demonstrate all of those, obviously those cost savings, but also that the business will have that debt capacity going forward. So from a practical point of view, this is in relation to information, this is about cash and cash flows. And certainly for the smaller businesses, we're very much looking at, and the banks would say this, that the P&L and the balance sheet effectively are more nice to have rather than essential. So we are looking, and Neil has suggested already, looking at weekly cash flows for the first 3 months, then extending out those monthly out to 6 months, and then I suppose appropriate to the business then what those look like over the next 12 to 18 months, and clearly those are going to have to be at a much higher level. So the key thing here, and I suppose, is also identifying and making clear the assumptions. The key thing is those projections then need to show that the business is going to have a return out of COVID-19, and then ultimately show that level of future viability. Okay. So next, on the next slide, I want to pick up on one point, which is very much looking at the whole area of focus on where people have tried to reduce costs or reduce pressure on the cash flow. And I think the big thing here is that it's looking at all of these areas. It's important that then there's evidence, I suppose, in the application that you have gone and done those. So Neil earlier has talked about the working capital lens, which is very much around the customers and the suppliers, etc., which is very key. Other things, obviously big expense overheads, particularly in relation to staff. So obviously if staff have been made redundant, or there's the furlough scheme again showing that in that part of the narrative. And certainly the other big one then is in relation to premises related costs. So what are the conversations that have been had with the landlords, and has it been deferment on rent? And certainly obviously the helpful support in relation to rates as well. Another big one that we are coming across is where companies have different funders, and the application needs to show what other negotiations have been had. And thinking here, for instance, particularly in relation to asset financers. So clearly, whenever you're looking at the at the application. It needs to ensure that there has been, I suppose, deferment of all funding. In relation to the government schemes, very much the job retention scheme has been very important, and obviously some of those amounts are falling into people's bank accounts now in the next few weeks. And taxation, Alan's going to pick this up as well, but again, in relation to deferral of payments like VAT, but also importantly, acceleration of other things like tax losses and tax credits. So I think it's a combination of all these things. And the one big message, I think, is in relation to making sure that these are cost deferrals. So the projections need to then show how those costs then will ultimately get paid. So the final slide, again, finishing maybe on a more optimistic note, is looking then at what is the position beyond COVID-19. And clearly the application needs to look at that. There's going to be a bigger expectation on larger businesses trying to have a bit more detail there. But key things, owners are going to be looking at this anyway. I think, as Andrew has said, is reaching the customers. So from a customer point of view, are customers actually going to survive out of this? Or are they even going to open the doors beyond COVID-19? So those are important. In relation to supply chain, there's going to be a big look there because some suppliers will not be there. And clearly, there's also evidence of increased logistic costs of getting product from A to B. So we think there's going to be a fair amount of looks at the business model, and some of those will require some sort of formal processes, we believe. So I think the other end, I suppose, in relation to Andrew said about the type of curve, and this will impact on the projections. Is it going to be V or others? What other shape? Certainly a poll we were involved in across the UK, of the respondents, more than half indicated that the expected recovery was to normalise was going to be greater than 12 months. So certainly unprecedented times. So summary, Louise, the big thing is communication. Get your application right first time, and certainly that will aid the processes.
Thank you, Charlie. Some good points around the loan application. Finally then, and last but certainly not least, I'd like to introduce you to Alan Gurley, our Personal Tax Director, who is going to give us some insights into tax strategies that can improve business cash flow. Now, Alan, we know that most businesses will have tax bills within their forecasts. And indeed, we've had a question coming through on the Q&A specifically in relation to revenue payments. So are there any tax reliefs or deferrals that businesses could consider to help reduce these over the coming months?
Yes, Louise, I think businesses have largely got to grips with the immediate measures around coronavirus, such as job retention scheme and deferrals. And I think now is the time to be looking at what other reliefs there might be, or how can you accelerate reliefs and defer payments. So if we look firstly at indirect taxes, and that's largely VAT. So we can have that slide, please. Next slide, please.
The technology was all going too well there. Oh,
there we go. So just a couple of points here on your VAT. Back again, please.
Back one more. And
that's it. There we go. So if you are in a business that has regular refunds, you could move your VAT returns to a monthly cycle rather than a quarterly cycle, and that can help put cash in the bank. Next point is around VAT bad debt relief. So if you have issued invoices paid over the VAT, but the customer hasn't paid you, there is a mechanism there. You can reclaim the VAT back from the customer, and that's certainly worth doing. On the right hand side there, the cash accounting scheme. So if your turnover is below 1.35 million, you may be eligible to join the VAT cash accounting scheme. There's no notification or permission required. You just make that decision, check that you're eligible, and move on to that scheme on your next VAT return. And that could be helpful just depending on how quickly people are paying you. Box there in the middle bottom, EU VAT refund claims. We have been saying to a number of clients for a while now that given that we are imminently leaving the EU, now is the time to look and see, have you incurred VAT in other EU jurisdictions? And if so, you can actually do a standalone claim, and it'd be useful to get that in as soon as possible, particularly in these times. And then the last, just at the bottom left-hand side, that box, if you have a supplier where you're paying a fair amount of payments to with VAT on, you might be able to negotiate whereby you pay the net amount now and then pay the VAT when you know they have to pay it, and that just can help manage your cash flow. We had a question through on the VAT deferral scheme that was on the coronavirus initiative. It's an automatic deferral, so any payments due to HMRC from 20th of March to 30th of June are automatically deferred until March 2021 with no interest or penalties. So that's an automatic deferral. There's no need to apply for that. If you have a direct debit system with HMRC, you were encouraged to cancel your direct debits. And there's more information on all the coronavirus initiatives on our website. Next slide, please. So for corporate tax, there's a number of things that people could think about. Firstly, if you make R&D grant or tax credit claims, or you have incurred significant capital expenditure and you're due to make capital allowance claims, you could see whether you could get those in earlier. The deadline for filing your corporation tax return and making those claims is 12 months after the accounting period ends, but there's no reason to wait 12 months. And a number of clients have been on saying, you know, they would like to try and accelerate that. So that's something that's very useful. Linked to that, you might want to consider a change of year end to, you know, collapse those costs early and get your claims in early. It can also be useful if the profits you're making are currently much lower, or even if you're making losses at the moment. You could consider changing year end to capture the periods where you've got poor months. Now, certainly I think April, May, June is going to be difficult for most businesses. So, you know, what's your year end, and are you capturing those poor months quickly enough? And if not, you could either extend or shorten your year end and capture those poor months. Next point, if you're on the quarterly installment payments, so that's larger companies, you have a lot of flexibility around making sure that the payments you're making tie in with your expectation of profit. And if it doesn't, you can reduce those payments. If you get that wrong, there's no penalties, but there could be an interest charge of 1%. And last point is, again, linked to what we've been saying around Brexit, if you have non-UK operations, get your profits back to the UK, just in case there's any change in the rules between various countries post-Brexit. Okay, next we're going on to look at employers. So for an employer's point of view, looking at paying your staff and how you reward them, what can you think about in these current times? There's three main things. Firstly, there's a number of tax advantage share option schemes. The most relevant one is the EMI. I've put a few details on it there. And we're in discussions with a number of clients about getting something in place now. Whenever valuations might be lower and the amount of shares you can get to certain employees can be significantly higher. So that's something that's very tax advantageous. Middle column is working from home allowance. This is a relatively recent allowance from HMRC. So if employees are required to work from home, they can get paid an allowance of £6 per week, tax-free. Important piece is that the employee has to be required to work from home. If they choose to work from home, then it's not a tax-free allowance. And importantly, HMRC have confirmed that if the office is shut because of coronavirus and your employees are working from home or required to work from home, they can be paid this allowance. And on the far right side, termination payments. I mean, some of these ideas are stuff that we looked at post the recession 2008 to 2010. There's an exemption for payments, ex gratia payments to employees or directors on termination of their employment. And I know this sounds quite negative, but in many respects, it can be very useful to create a settlement between an employer who really wants to reduce costs, an employee who maybe is relatively comfortable about moving on. They just want to make sure that it makes sense for them. So when you have a 30,000 limit plus maybe doing excess contributions into a pension scheme, you can pull together a significant package, severance package for employees that can actually be a win-win for both sides. So next I'm going to look at income tax. So for those businesses that are partnerships or sole trades, there's a couple of things that can be thought about. Firstly, on the left-hand side there, one of the coronavirus measures is a deferral of all self-assessment income tax payments that are due on 31st of July. So that's whether it's individuals, partnerships, trusts, all those 31st of July tax payments are now deferred until January 2021. No penalties or interest. This will cover people that maybe are employed but have investment income, maybe people that are high net worth individuals, people that have rent. So all those payments, all the tax due in those payments is deferred from July to January. Again, that's automatically a deferral. So that's something that's been quite welcome. On the other box, again, linking back to corporate tax, so if profits have significantly fallen or indeed you're loss making, a change of year end might actually accelerate when you get relief for those poor months. And that's something that the clients should consider. We've done some numbers for a couple of clients, just looking at moving the year end closer to 5th of April and accelerating when they get those losses. The last point is, you know, if there's losses being made, there's some generous reliefs in the income tax legislation to set those losses against other income. Just looking at a couple of other ideas, and again, these are things that really we're looking at with a number of clients and come from the toolkit of 2010 and onwards. So if you have minority shareholders in your business, the values might be lower at the moment, and therefore, you know, it might be easier to do a deal to buy them out, and they might welcome the cash. Second point, if you're thinking of making gifts of non-business assets, the values may be lower now and taxes may be higher in the future. Quite often with those types of assets, you're triggering a capital gains tax charge by making the gift, and that might be lower now. And I think people need to, you know, bear in mind that taxes could be higher in the future. Third point, if you have an investment portfolio of stocks and shares, it is possible with certain investment managers to get some borrowing in against those stocks and shares. And that can help clients that want a bit of cash out of their portfolio, but are disinclined to sell any investments with values being so low. So we have a number of clients who've got those facilities and the rates are extremely low. So that's something to think about. Fourth point, you know, again, we would always encourage clients to make sure they capture, record, and claim all losses. So if they've made bad investments or property stuff that's gone wrong or anything in their history, you make sure you get that logged, claimed on your tax return, because you can carry those losses forward indefinitely. In certain circumstances as well, they can be set against other income and generate a refund. Last 2 points are really around pension funds, and the first one Neil referred to earlier around swapping assets from your pension fund, you know, whether that's your pension fund has cash, lots of cash, you have property assets, and whether you want to get access to that cash, you could basically sell your property to the pension fund. It's like a form of asset swapping. Transactions must take place at market value. With regulated pension schemes, there's a range of things just to observe, but that can be done. And last point really is if your pension fund has breached the lifetime allowance, it may be not less of an issue now if asset values are falling, and this could be like a reverse swap. And that's one thing we're looking at for one client. So my last slide really is looking at sort of asset protection. This is where I spend a lot of my time, helping shareholders manage their personal position and consolidate things for the long term. A couple of things we're looking at for clients at the moment is, you know, one thing I would notice, a lot of businesses went into this issue with very, very robust balance sheets, surplus cash and strong performance. And there's just a couple of things to talk to clients about, whether they want to get some of that cash out and whether they want to perhaps use it to buy out one of the shareholders. If that's going to be done, advanced clearance from HMRC is required. Similarly, making pension contributions is very tax efficient and very, very good from a personal protection. That wealth is pretty secure. It's there for you for the future. On the right-hand side, we would talk to clients regularly about transferring assets into trust as a long-term IHT mitigation strategy. but there's also great protection for potential beneficiaries from an asset protection point of view. And then last panel across the bottom there, we're doing a lot of work at the moment with clients looking at group restructuring, where they maybe have valuable intellectual property, cash, other property, and just how we protect that from any trading shocks. And there's a couple of ideas there, whether that's put a new holding company in place, whether that's move assets around your existing group, or whether it's a full demerger of those assets out. And just a couple of last points. Some clients who maybe have lent a lot of money back into their business, we're looking to see, can they be provided security for that lending from assets that maybe are currently unencumbered. And last point for me, I think now is the time to consider group rationalisation. So if you have lots of dormant companies around your group, you could actually save ongoing costs and trigger some losses that you can use now by having them struck off. So Louise, that's everything for me. Back to you.
Thank you, Alan, for that very comprehensive overview. So we have had some questions that have come through for the panelists, and we have 8 minutes to get through these questions. So hopefully we'll get through most of them. The first one is for Charlie. And Charlie, this is any insight from other clients in turnaround of the government loan applications. A recently registered local bank is telling me that due to the paperwork involved, they will not be in a position to submit our application until the 11th of May at the earliest. This is despite having everything they need from this client.
Okay, well, I suppose to take a point, I think this is a process that's dropped on the banks. So I suppose part of what the banks have been doing internally is to try and get their systems in a position to deal with the volume of I suppose applications that are coming through. And remember, it's not only I suppose the government-backed schemes, but they're dealing with a whole lot of other solutions as well that need to go through their credit processes. I mean, I suppose on a number of occasions, the textbook effectively has been the week to 10 days effectively. I suppose the caveat on that and all these things is the quality and reliability of the information going forward. So I suppose reiterated that point back to the audience today, that is absolutely critical. And certainly from our point of view, we have seen turnaround within that period of time. What has that taken? That's taken quite a bit of effort to try and make sure everything is correct going in, sitting on top of the person who has been evaluating. And I think the one benefit I think on it is that the one that I'm talking about was below that 250k ask as well. So, you know, that's the I suppose that's the experience from what we've seen.
Okay, thank you, Charlie. Next question, I think Andrew, you might be able to deal with this one. So the furlough scheme is very welcome, but it is a blunt tool. I don't see us bringing all staff back full time as we unlock over time. Do you envisage government reducing the 80% to say 60 or 40% to allow staff to return on a part-time basis?
It's a good question. I think the speed at which the government came out with a scheme like furlough, there were questions around, was it too generous? I think the intention was to maintain a confidence. I spoke earlier about confidence and how that's so crucial to what we do. So as we move out of this and we move in, you know, we've had our respond phase. I think we need to start thinking about how we restore and move into that phase. And you know, last night we saw Japan has passed a bill to drop cash into every resident's account. So there's lots of different ways that government are acting on this to move into restore phase, be that direct injection of cash into people's bank accounts to hopefully motivate spend. It's not beyond the realms of possibility that the government will look at a furlough scheme and think, as we move out of this, that has been generous. We could reduce that. Companies themselves could look at various ways of moving staff to reduced hours. I know some conversations I've had with companies have suggested that they're reducing hours for some people, but on a generous pro rata basis. So if you do half your time, they're prepared to offer 60% of the salary. So firms are being quite agile here, and I think government needs to be as agile as we move into the restore phase of this pandemic.
Okay, thank you, Andrew. So last question, just due to time, and Charlie, Charlie or Neil, for yourselves, what type of interest rates are being charged on the loans?
Yeah, I'll pick up on that. I mean, different banks are taking different approaches. I mean, I have seen one bank who are at, I think it's 3.5% if it's up to the 3-year term, or 4% if it's up to the 6-year term, and that's with CBILS. Other banks are pricing them in line with other facilities. So generally within a bank, you'll have a sort of standard margin. And it'll depend on the product. So sometimes your standard margin on your term facilities will be, let's say you're at LIBOR +3, your CBILS loan should be at LIBOR +3. Sometimes your overdraft might have a slightly higher interest rate. You might be at 3.5, but there shouldn't be that much of a difference. So it should either be one of the two. I mean, ask your bank if they have a set rate that they're applying to CBILS loans, dependent on the type of product and the term. Or, as I think most banks are doing it, it should be on your standard margin that your other debt is on, be that a term loan or an overdraft.
Okay, thank you, Neil. So on that note, we are going to wrap up. So I'd like to thank everyone for attending. Sorry we couldn't get to all the questions, but we did want to keep it within the scheduled hour. I do hope that you found it practical and can apply some of the points to your business. If we haven't addressed all your questions, please feel free to contact any of the speakers directly. So thank you again. And in the current climate, I feel obliged to finish off with stay safe and wash your hands.